The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Larry Pesavento.
Okay, good afternoon, folks. Well, we have a situation today where we've got to send some prayers out. First of all, for our good friend Mickey Rooney. He was an actor for many, many years, and we were fortunate enough to live very close to him when we were in California. And my lovely sainted mother, who died very early, was out to see my second daughter being born, and we were in the supermarket, and Andy Rooney was there, and that was her favorite actor. And I wish you could have seen my mom. She was 46 at the time, no, 43 at the time, and she was like a little kid. And she was very short anyway, but Mickey Rooney was even shorter than she was. I believe he was married 10 times. I know the last time he was married for 25 years. That was to his high school sweetheart. Well, he passed away at 93 today. Also, we need to say some prayers for some folks in Hong Kong. We've had 4 people, at least 4, in the last few weeks in Hong Kong that have jumped to their death, and in the financial industry. A couple were in the futures industry and a few others in the hedge fund business, but that's a very, very unusual situation over the last few months that's occurred. So it's been it's very trying on everybody's families and everything. So let's remember those folks in our prayers. The other thing that we want to mention is that we've got a situation now in the social media stocks and also the biotech stocks that we have shattered the lows of March 17th. We've also done that in the NASDAQ also. It's just been a real bloodbath over there, and I think it's going to get a little worse. That's just my guess. If we close badly today, which badly to me would be down more than we were on Monday, and the Dow down more than 150, that would be an indication that we are continuing down. If you'll remember, last week we talked about the chart that Mr. Z from the Tiger Den put in where he showed that there was, fact is I can put that up just to repeat this to show the relationship of where we were in 2007. And you can see that we were 39 days from the high on that particular move coming into where we were on Thursday. We made a little bit higher high on Friday, but it didn't really do very much, as you can possibly imagine by now. But the first objective on this would be below those lows of March 17th, and if we take those out, that's equivalent of 1833 in the S&P, folks. That is so bearish that it's amazing how bearish it really is, because that's the same equivalent of where we were on August the 15th of 2007. You remember we went up for 56 calendar days from August 15th into October 10th. Then we took that low out, and of course we went down quite a bit. This year we bottomed on February the 5th, and we topped on April the 6th and the 5th. And that was 57 trading days, and that was also making a little butterfly pattern up at that time. So whether that's going to be the case or not, but it started in the right direction, so that tells us that, yes, possibly that this is it. There is absolutely no fear in this market, folks. I was excuse me, I was listening to Basil, and his analysis of the VIX was so spot on. It was really really amazing. And once that VIX index finally turns up, then I think you're going to start to see some acceleration in some of these things. The other thing to look for is the potential for other selling, because if margin call selling does come into this market, and it's not going to come in at this level, it's going to come in at a lot lower level. That much I can promise you. Well, I can't promise anything, but that's what I would be assuming would happen, and you know how you spell assume. But that has not happened yet. But you would get sympathetic selling in other things like gold and silver and crude oil and grains and other things as people move money around to try to protect their positions or liquidate just for margin purposes. I've been involved in one of these before, back in 1974, and it's no fun. I can tell you that if you're on the wrong side of one of these things. And this market's been one-way Corrigan, ever since March the 9th, March the 5th of 2009. The other place you have to watch really closely is the February 4th low. Now we've shattered that in the social media stocks, like Facebook and LinkedIn and I can't remember any of the others. Twitter. I mean, they just massacred those stocks. They're making new lows on the year, and that's a very, very negative sign. And the other one that is very interesting to watch from a technical point of view is the IBB, because that also is another one that is. Just give me 1 second here. I've got to pull that IBB chart up, and then I want to do the one for the IBB is actually holding up better than some of the others today, but it looks like it's got a price objective at least another 10% lower. But it's taken out the February lows already in the biotech index, and that gives us a price objective at least 10% lower where we're looking at. That would give a big ABCD down at that point. As a matter of fact, I think I ought to put that in there just to show you folks that the rally that we had, that 5-day rally, just took us up to a 382 retracement in that IBB. And believe me, that is such a minor correction given the fact where this market has come from. It's really not very much. And that's why I don't think it's different this time. I think it's going to be a lot different. But we'll see. That remains to be seen what happens as we go through here. Now, the other one that I wanted to talk about that's also under a great deal of pressure, that has been quite negative for quite some time. It topped a lot earlier. It topped, way back here in on March the 6th, and that's the small cap index. That one has been coming down, and we're right at the 61% retracement now. As we're speaking here in the IWM, but frankly, the fact that we've had these really strong down days coming off of a 61% retracement, usually it tells us that we're going to go a little bit farther to the downside. So those are the ones that that I'm keeping an eye on, because those are the stocks that led us up. In 2007, those were the same stocks that let us down. In 2007, of course, it was the financial stocks, the Lehman Brothers and all the others. Well, there's a lot of other ones that were doing the same thing too. But I think if there's any one, there's only one. Well, there's lots of charts, but the first chart that I posted in the Tiger Room today was the Dow Jones long-term chart going back to 1896. And as you can see, the low in the Dow Jones this is the transportations in 1896. Now remember, there weren't many cars at that time, folks. This was horse and buggy era. Trains were the way they were moving at that time. It was a big railroad era, and it bottomed on October the 29th of 1896. And if you can remember that date, October 29th. That was the same, coming into the same time where we were in 1929. That's where these anniversary dates, pop up and see these things come up. But if you want to see the difference between what's happening with the Dow Jones transports and the Nasdaq, I wanted to show you the relationship here, because the transports made a new high on Thursday. And as you can see, the Nasdaq has been coming down for over a month. So it topped, a month ago on March the 3rd, and it has been rolling over ever since. We're getting close to a 786 retracement in that Nasdaq as we speak, but it's still, extremely, extremely weak. The key figure to watch for me is the 1833 level in the S&P futures, and after that, 1821. Below 1821, boys and girls, you can turn the lights out at Wall and Broad, because that market's going to be in a major bear market, and the faster it gets there, if it gets there quickly, the worse it's going to be, because that's going to be similar to what we had in 07 almost identically, and we're watching that just to see what's really happening. I've had several emails. over the weekend asking me about this date that I've talked about before, this April 21st, 22nd date, where we have these multiple aspects occurring. People are concerned about it being the end of the world. Folks, believe me, forget about trying to predict the end of the world. You only got to be right once, and it's going to be too late by the time you figure that out. It has nothing to do with anything like that. It just means that there's a lot of energy points coming together on the 21st and 22nd of April. That's the day after, the 2 days after Easter. It could happen over the weekend. I don't know. They've asked me if it's related to a, some type of a terrorism thing. I have no idea. I mean, I really don't know. All I'm saying is that when we've had these before, they've been quite big. The difference is this time we've never had one like this before. Never in recorded history have we had this many energy points coming together at the same time. Classical astrologers call it the Grand Cross, but I don't really understand that. I know it has something to do with the four outer planets, Jupiter, Saturn, and Mars, and was it Jupiter, Saturn, Mars, and Uranus. So those are, but I think it'll really be big. I think it will be in the news, but whether it has anything to do with the market or not, I don't know. In 1989, I saw something similar to this, and it was the fall of the Berlin Wall, but the markets didn't do anything. So we'll see what see what's happening with that when we get to that point. So nothing to do at that particular time, and we'll see what happens. By the way, I mentioned last week about Mr. Rogers being a Navy SEAL. Actually, my friend, I misinterpreted what my friend was trying to do. He was making a joke to me. He actually is a Navy SEAL, and the reason why I asked him about it, because I said, hey, I told these guys that Rogers was a Navy SEAL, and he said, no. He said, what I was trying to do, he says, everybody wants to be a Navy SEAL, but no one actually goes through the program. So I was just trying to set the record straight that was the case. So anyway, we'll see what happens, when the next time I do something like that. I'll certainly try to be a little bit more be a little more precise when I give that kind of information. But he was actually making a joke in my favor. Okay, we got the Dow Jones is down about 130 points. We needed to get down to more than 160. Then it will be in some serious trouble. If we get the S&P below 1833, it's really in trouble. 1821, it's really, really, really in trouble. We're going to have to talk about the gold and silver here a little bit too, because we didn't get much of a bounce off those major lows, and I'm a little suspect that we might be getting caught up a little bit in some of this margin call selling. I also want, when we come back from the break here that we're going to have shortly, I want to review the price of Amazon and also the price of Apple, because we talked about those over the past few weeks, and they're starting to perform to what we think is. So we'll be right back. 877-927-6648.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Wouldn't it be great if you could get a red light, green light indicator that gives you signals on 25 different future contracts? Now you can with Taz Signal Box. This red light, green light market profile system dynamically updates 24 hours a day and provides you with important trend and trade signals on 9 different commodities, 9 different indices, and 8 different currencies. Right now, you can receive a free 2-week trial to Taz Signal Box. For all the details and to find out how the Signal Box works, visit the front page of TFNN.com.
Andy Heck's powerful weekly newsletter, the Technomental Commodity Report, has delivered multiple triple-digit winning trades in recent months. And right now's the perfect time to get a full month-long trial to Andy's newsletter with no obligation to pay anything. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Technomental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you'll lock in the low rate of only $59 a month. Sign up right now for the Technomental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on Chinese stocks, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foresight Fund Services, LLC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. Larry takes your phone calls now, toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, we're back, folks, and we have some really smart people in the www.tfnn Tiger Trading Room, and one of the gentlemen, Mr. Peak, I hope he's looking for a peak. If that's the case, just posted a article about Andrew Jackson and this about his involvement, I believe, with the Federal Reserve System. He was the person who was really against it. This is when we had the Second Bank of the United States back in 1835. One of the things that I've said is that it's the Tiger's Den. If I misspoke. Anyway, if you get a chance, you should read the book, The Den of Thieves. It's really a good story. What am I talking about? It's the the Creature from Jekyll Island. That's the book that you'd like to read. The Den of Thieves is the one about Drexel Burnham Lambert. But that book on Jekyll Island is really good about the Federal Reserve, and it was based on part of the fact that it became in being in 1913. And that's because the panic of 1835, the bank was disallowed. We went to a regular banking system at that time. We didn't have a Federal Reserve. And this big cycle, that's a 170-year cycle that I looked at, during that time. That was the one I was looking at for 2007. Now, I don't know how long that would be, but, it's a 170-year cycle, and we're 10 years into it. I don't know if the first part of it was it or not, but that was a really bad panic that we had back in 1835. And I don't know if that'll happen again, but you'll start to see it in some of the currency markets if you see that, because we didn't have, exotic currency markets back then. And we didn't have bond markets like we have now either, or stock markets, but it'll be different this time for sure. But Andrew Jackson was one of my favorite presidents, and I certainly I certainly like to do that. And I posted a chart into the Tiger's Den today, the Tiger TV, and basically what I'm looking at here is the price of Amazon. Back on April the 17th, we were making a 61% retracement, and we're getting close to coming down to a 786% retracement of the low that we made way back in August. There's a big ABCD pattern there, as you can see. So if the market does start to turn, this will be one of the stocks that I think would turn first. So I'm keeping an eye on Amazon to see if it has any, question of whether it's got a chance to bounce from here, because that's something I'll be looking for. And I just think it'll be a bounce, folks. I think we're in a pretty substantial run here to the downside, at least for a few days. This is only the second day down. We have Friday and Monday. This is really nothing compared to what's happened in the past. Now, the next stock that I've had some questions about is the price of Apple. As you can see, back in December, we were making a 61% retracement up at the 580 level. We came down to the 494 level, and then we rallied up exactly to the 61% retracement twice. We did it once on February 3rd when the rest of the market was making a low. Apple was making a high. If you remember that low, that was a big low back on February 3rd. The market moved up 13% from February 3rd until April the 5th. I'm in desperate need of a break, folks. In April the 5th, and they moved up 14%. In 2007, it moved up 12% in 56 days. And it looks like what we're looking at now is a price objective of around $4.50 a share in Apple, which should be down another 20% from pretty much where it is right now. So that would be the type of move that we would be looking at possibly, in the overall market. The question is, how quickly do you get that type of drop? Now, if you notice what happened in 2012 when Apple topped at 703, it gave back 25% of its value in just over 2 months. So when these markets come down, they come down faster than they go up, and so you have to be able to realize that that's an important thing, because the gravity is what pull these things down. So we'll have to wait and see. The fact that these social media stocks and these biotech stocks have given up so much and are breaking down below yearly lows and stuff, that's a really negative sign, folks. I know they're still way up in the air, but these are the same things that happened before when we've had these types of markets. So you've got to be able to, keep in mind that this is what can happen, when they start to the downside, because markets are really the same. They never really change very much at all. And what happens in the past will happen in the future. That's in the Bible and another place. Okay, got the Dow down 130. We got gold and silver down a little bit, which we'll discuss after the break.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Patterns, profits, and peace of mind.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's trading newsletter.
Patterns, profits, and peace of mind.
In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the Forex market, and more. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 full weeks. That's an $85 value. Yours free when you register right now.
Get Larry's Patterns, Profits, and Peace of Mind.
And get the edge you've been looking for.
No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 9 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can't use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com. Educating investors. This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, we're back, folks, and we've got our friend Mr. Z from Boston, from Philadelphia. John, are you there?
Larry.
You didn't move to Boston, did you?
What's that? No, I didn't.
How are you doing, my friend?
I'm very well, thank you. We're on the right side of the market, so that's always nice. Larry,
you're on the right side almost all the time, partner, so don't give me that baloney. What can I do for you, my friend?
Okay. I would like to ask you if you could pull up the weekly chart of CME, the Chicago Mercantile Exchange common stock, and tell me where you think this is going. But, Larry, as a preface to your addressing that subject, I'll make an observation about the stock indices. At this point, the selling, of course, is orderly. The VIX is up, but it's not spiking anything dramatically.
Absolutely.
The S&P is down 1%. Yeah, it's noticeable, but it's nothing out of hand. Now, I just went and I observed something this morning that caught my attention. And it's a couple of key financial stocks, and I have learned to do this for 20 years now. Namely, when things appear to be getting out of hand, I always go look and put on my quote screen 4 or 5 equities. One is CME, the second is ICE, the third is STT, State Street Bank out of Boston, and 4 is BK, which is Bank of New York. Now, these are critical financial institutions, and when things start to go haywire internally, start to go haywire before we as lay people hear anything in the news. The haywire manifestations show up in all the inside players selling out these names. And I've noticed today that those four names that I mentioned, they are all down more than 2%. And take the CME, for example. Of course, this is the world's biggest publicly traded derivatives exchange. And, of course, derivatives are just, financial contracts as we know, but they are levered financial contracts. And when price moves big, leverage cuts both ways, and somebody is taking losses. And CME, besides being an exchange, is a massive clearinghouse, as you well know. And in the event that one side of a trade goes bad, it's the clearinghouse who ponies up the cash to pay off, a bad debt, if you will. And when that, if traders take losses, it would be the clearinghouse that would be suffering, and hence the equity holders of CME. And I just can't help but think something's going on here because the CME stock is diving as we speak.
You're absolutely correct, John. And we went through this about 18 months ago with John Corzine, if you remember, our esteemed senator from New Jersey, I think is where he was from, and all the problems he had in with his company that went belly up. And, many of the people still have not got all their money back from this, and the CME did not back the customers like they thought of. So what you're talking about here is counterparty risk. In other words, who's on the other side of some of these, weapons of mass destruction, as Warren Buffett talked about. And I'm very concerned about that because of the situation like we had in 1987 when we had pretty much the same thing going on. And yet it was the Federal Reserve Bank when they came in with their plunge protection team and basically stopped the market from going down that day. But that was, one of the greatest buying opportunities of the 1980s was on August of 87. And whether it's going to be the same thing or the same scenario or not, I don't know. But I do worry about the counterparty risk involved in some of these things because some of the people that I run into, being, in the tiny bit of the public life that I am, they have no idea what some of these things are. They don't know what a credit default swap is. Well, not that I know, but, or CDOs or some of these other things. And they don't even understand what short selling means, and many of them don't even understand the whole concept of margin. And these ETFs and stuff that they have that are double and triple leveraged, it's a little scary out there sometimes. And I think that's the thing that's not apparent right now in the market. We're not having a big sell-off of any kind because the market's holding up relatively well, given 2 hard down days, and that's really all it's been is 2 hard down days in a bull market.
Indeed, Larry. I'm looking in the Tiger's Den. Thank you for posting that CME daily chart. We're at 68 and change. Do you see this going down to that 63? Is that...
that could be there in just a few days. We went from 73 to 68 in 2 days. If we did the same thing, we would be there on Thursday. So, or Wednesday or Thursday. It could very easily be there. And if we get there too quickly, that means it's going to come all the way down to 57.
Right.
So we don't know yet. It's still very, like you mentioned, it's very orderly here. The VIX is doing virtually nothing. It's up a little bit, no spiking of any kind. And you've got to get the S&P below the 1833 level, which is quite a ways from where it is right now. But if we get through there and through 1821 in the S&P futures, then you've got a big problem. Then that VIX will be going. There'll be a parade going on in that VIX when that happens because people will start to take protection, and that's when you'll start to see it. Remember, John, we've seen this many times before. The margin call selling doesn't come at the top; it comes in the middle to the end of a move.
Sure.
That's when you get the biggest part of the drop. The most amazing thing that I've seen so far is the fact that the similarities between 2007 and 2014 with the price moves, one was 12% up in 56 days, the other one was 14% up in 57 days. The patterns were very similar. The times were correct. All the major patterns on the transportations and the NASDAQ and all these other things have fulfilled. We're looking at something really big here. I think it's as big or bigger than what we had in 07 for sure, and most probably as big as what we had in March of 09, but maybe on a mirror image of that. So we'll have to give it a little history to let it see if it does that. But that's what it looks like to me.
Right, Larry. I just have to share this with you, following along this train of thought on the CME stock. I'm just looking back on the monthly, going back to 2008. It peaked at like 88. It fell down to 31 in the crash of 2008.
Wow.
Larry, as I'm looking at it, from the 2008-9 low, it rallied $40 into 2010. It went sideways into a low end of 2011 at 45.
Yeah.
It rallied to 85 December 31st, another $40, a perfect ABCD.
Yeah, it was exact 50% retracement of the high from 07 too.
and as I say, this, the selling in this, sometimes CME would be under selling pressure if in fact, say, volumes of transactions were declining, and that's not the case as we speak. And this aggravated selling the past week or two, to me, looks like just a big red flag that big players, the big bank trading desks are sniffing something here. So I just wanted to highlight that as being a potential canary in the coal mine signal for us all to track closely.
Well, I agree that's what we should be doing. And, most of these folks that have been in stocks for such a long time, they don't have any idea what fear can do to people. We haven't seen any of that yet, so there's no reason for them to be afraid. But if you start to see a couple of really bad down days, and a bad down day in the Dow now has to be more than 300 points because we've had several days of up 300. So that means, the fears of greater emotion than greed, so we should come down at least 1.618 faster than we went up. So 300 times 1.618 takes us 500 points. When we see the first 500-point down move in the Dow, that's going to be, to me, is going to be this one of the big triggers that says, something's different this time, and it's not good. So that's what I'm looking at, is if we do get a 500-point move down in the Dow, which I will believe we will. It's just a question of when that's going to happen.
Yes, very good, Larry. I do appreciate. Of course, you posted up in the den the CME daily chart, going not only to that peak of 2008 at 85, but all the way back to the 2007 peak, and it's very illuminating. So thank you on that, and thanks for all your good works. We appreciate it, sir.
Well, John, let me say something here before you leave, okay? I can't tell you how much I appreciate the stuff that you share with me and the other folks in the Tiger's Den at www.tfnn.com, because you've got some of the greatest stuff in there that I've seen, and I've been around for 50-some years, and you really know what you're doing, and I really appreciate you sharing your information with us, and I know the folks in the Den certainly do, and you're really good, buddy, so stay in there, okay?
Will do, Larry. Thanks so much. It's great to talk to you, sir.
You bet. We got a call from one of my home bases where my daughter lives in Denver, Colorado. Warren, are you there?
Yes, Larry. How's it going today?
Well, I'm okay today. How are you today?
Good. It's nice weather here in Denver.
Yeah, you're having that 1 day above zero. Is that what it is?
Yeah, we just have alternate days. Snow, nice, like that.
What can I do for you, my friend?
I want to look at the Bradley model.
Sure, I'll put it up here into the Tiger Den, and you'll be able to see it.
How that the 18th to the 21st, where it occurs in the Bradley model, and how that affects it.
Okay, Warren, what we have on that those combined aspect dates has a very minor effect on the Bradley type model.
Okay.
The reason for that, Warren, is I follow the Bradley model exactly like Donald Bradley brought it out. I don't change the weightings of Mars or Venus or Mercury or anything like that some people do, and that's why you'll see Bradley models that are different than the one that I use. I used the one that he did, and I back tested it Jim Twentyman and I and Dr. Ruth Miller back tested it for 120 years, and we know that it has a better than 75% chance of hitting these dates pretty much spot on, and the trend relatively good most of the time. So that's what we're doing. That has nothing to do with what I'm looking at on May 21st or 22nd. That was work that was done by my co-author of our new book that'll be out sometime this summer, Shane Schmolny, and he really is the one that took this information and statistically looked at it. We talked about the importance of these things coming together, and then we used Alfie Lavoie's software program, the titanium program, to get to the spot where we could test these, and we see that these are really big. And what we have coming on the 21st, we have no test for because we've never seen one this big. We've had some bigger ones before, but this is pretty big.
Right. Well, it looks like I was looking at the screen, and it looks like there's a big downturn coming in the Bradley model, and that would kind of almost coincide with this.
Well, we had a double top here. We made a slightly higher high by about 20 Dow points from what we did on December 31st on Friday when we had the bullish news. And then after that, we've turned down. We've had 2 wide-ranging days down so far, which isn't really very much, but it's bigger than we've had any time during August or September or even December. We've never had big downturns like this because we're down, almost over 400 points from the high in just a matter of a day and a half. So if something is going to happen here, all we need to do is to get the Dow below, 16,000, and I think there's going to be some people that are going to be looking at their whole cards to see what the next card coming off the deck is going to be.
Well, yeah, I could definitely go down 5%. That's for sure. We're only off like 2.5%.
Oh, yeah, that's it. Well, you can see what the Nasdaq has done in the biotech index and the social media stocks. They've really massacred those. That's been a really bloodbath going over in those, but you never hear it when you watch Bloomberg or anything like that. You've got to go get the information yourself because they certainly don't report on that.
Well, yeah, Bloomberg makes money on good news.
Well, I think everybody is supposed to be doing that anyway, so we'll see how that works out.
Sure. Well, thanks for showing me that, Larry, and I really appreciate it. I love what you do on your show.
Well, thank you, Warren. That makes me feel very good. I appreciate it. If you see my daughter today, tell her I said hello, okay?
Okay. All right.
All right. We'll see you later. Okay, we got a call from Massachusetts. Tom, are you there?
I am, Larry. How are you today?
I'm okay, thank you. What can I do for you, my friend?
Well, I'm looking at that TZA. I called you late last week, and I'm still in it. I'm wondering maybe we look at an exit point today.
Call somebody else. No, you got to give this a shot. I know you're looking at that ABCD that's there, and maybe that's the thing to do. But frankly, I think you've got to give it just a little bit of room, my friend. Okay. This has got a shot. Actually, what you would do is if you're really nervous, is if it takes out today's low, then I would say, yeah, you made a mistake and you should have got out on the ABCD pattern that was there. But frankly, you don't catch it all together like this that we're seeing right now with the collapse of the Nasdaq and everything else. And that's the big difference. So you either get out right here and buy it back higher, or hope that it goes lower.
I'll keep the moving stop going up. Okay.
Yeah, that's what I would do.
Thank you, sir.
Okay, thank you for calling in, folks.
Bye-bye.
Bye-bye.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy, a set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders, take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
Up next, the Diagnostics Trading Hour with Daryl Martin here on TFNN.
Okay, we're back, folks, and I wanted to end the show today with the price levels that we're looking at that are extremely critical from the bullish point of view of the stock market. Because if we go below these levels, we're in big trouble, in my opinion. That is 1833 in the in the June futures, S&P futures. That would be below 16,100 in the Dow Jones, and the Nasdaq has already gone below it. So, but the S&P is it's 1833. That's the one that is the real key one to watch. We need the Dow down more than about 160 today to see some follow through. Whether that happens or not remains to be seen. Now, I wanted to spend the last few minutes here talking about the gold market, because we bottomed here about a week ago, and we had a very nice ABCD pattern complete up at the 1303 per ounce level. That equates to what's happened to our XAU. We've got our friend from Singapore. William, are you there?
Oh, I'm here. I have If you want to talk about gold, I think that's important too.
Let's stick with gold because I noticed that you want to talk about intuitive surgical, right?
Yeah, that's right.
That only rich guys can trade that kind of stuff. So let's focus on the gold here. What we have to watch for, William, is the fact that we must hold these lows that we made down here at the 1,200 and 1,250 per ounce level in the gold. It's very important that we hold that low because if we don't, that's telling us that the rally that we had off of that big low is not nearly as good as we would like to see it. And with silver acting very, very poorly, silver should be trading up and around 2050 per ounce based on where gold is, and it's only at 1988 per ounce. So it's been lagging, but that could be just because of the regular industrial demand for silver. I don't really know for sure.
Okay. So at this point, do you think that, the chances for gold to move to the upside is higher than, to the downside?
Yes, I still believe that the odds favor a higher move in gold from here. But if we take out those lows we made just about 7 days ago, then that will not be the case. Gold has very strong support, William, at the 1868 per ounce level. That's the 61% retracement of this last 8-day move that we've had. As long as we can stay above 1868 to say 1850, gee whiz, from 1268 to 1250, then I think we have a pretty good chance of holding up. So it's 1268 to 1250 in the gold that must hold.
Okay, because I just got long into the options on GLD just last week.
Mm-hmm.
Yeah, so I'm hoping that my take is correct.
Well, hoping is not a good word. Be sure you react. Don't worry about the hope too much. Okay.
Okay, I will. I will react to it. So in that case, can I say that because silver is lagging? So if gold is moving up well, then it is also good to look at silver on the long side.
Well, I don't like trading silver because it has pockets of illiquidity that are very difficult to explain. I think just some traders just are not trading it like they used to. And so, yes, it has the same characteristics as we have in the gold market, but gold is far, far easier to trade with greater liquidity and greater volatility, so it's much better to trade gold than to trade silver.
Right. And I think lastly, what you told me about the Apple and Tesla is really come true. That
it was your money. It was your money that shorted it, not mine. All I said was it looked like it was overbought. That's all I was thinking.
Yeah. Thank you very much, Mr. Pesavento.
Thank you for calling in, William.
Yeah. Thank you.
Okay, that's it, folks. Live every day in an attitude of gratitude, and may God bless.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
You're watching Tiger TV.